Welcome back to Investing Talk Podcast. Today we're digging into the sources you've sent us on a really volatile small-cap biopharma, Reviva Pharmaceuticals. Our goal here is simple. Look at the info and try to answer that big question. Is Reviva Pharmaceuticals a good buy right now? And hey, before we jump in, just a quick reminder, please subscribe, like the video, drop a comment. It really helps us out. Also, if there's a specific company you're curious about, let us know in the comments below. We might just cover it next.
Yeah, Reviva. When you look at these clinical stage biotechs, you're often looking at what we call binary outcomes. It either works spectacularly or it doesn't. Reviva is kind of the poster child for this. It's definitely high risk, but the potential reward, potentially explosive. The whole story, really, it hangs on their main drug candidate. And what's striking here, what jumps out from the sources, is this huge gap between its current stock price and, well, where analysts think it should be. That creates what everyone's talking about, this asymmetric risk-reward profile.
Okay, let's unpack that asymmetry because, honestly, the numbers you see in these reports are pretty wild. You said a big discount.
Yeah.
What are the analysts actually saying? How big is this potential opportunity?
It's potentially massive, which is why it gets so much attention, right? The stock, as of October 23rd, 2025, was trading around, what, 57 cents? $0.57. Now, look at the average analyst price target. Conservatively, it's sitting somewhere between $4.50 and maybe $4.86. Do the math on that. You're looking at an implied upside somewhere between 755% and, well, over 935% from where it is now.
Wow. Okay, nearly a 9 times return just based on the average forecast. That seems incredibly bullish for a company that doesn't even have an approved product yet.
It is aggressive, and it actually gets even more extreme. The highest target we saw mentioned, $11 per share. That one single target implies, what, over 2,400% upside potential? But here's the kicker, something the sources really highlight. The level of agreement or conviction among analysts. Across the board, you see ratings like strong buy or moderate buy, that kind of unified bullishness. It's pretty unusual for a company at this clinical stage.
Hold on, though. An $11 target, maybe 2,400% up, but the stock is languishing way down here, like 900% below even the average target. If all these analysts are screaming buy, doesn't that mean the market just doesn't believe them? Or maybe the market thinks failure is already baked in, something the analysts are overlooking?
That's exactly the tension, isn't it? The market is deeply skeptical. That explains the low price. It's pricing in the risk. But those high targets, they aren't just wishful thinking. You have to understand the why behind them. These projections, especially that $11 one, they're built on complex models that assume the drug gets approved, it launches successfully, they factor in potential peak sales, billions of dollars if brilaroxazine manages to grab even a small slice, say 5% of the markets for schizophrenia, bipolar disorder. So basically, the analysts are valuing the future, the drug's potential down the road, the market. It's valuing the present, the cash situation, the immediate risks.
Right, that clarifies things. So the crucial question becomes, does the science actually back this up? Why are analysts so confident in this specific drug, brilaroxazine? What makes it special?
Well, the excitement really comes down to how brilaroxazine works. Its edge, according to the sources, is its unique structure. It's what's called an SDAM, a serotonin dopamine activity modulator.
SDAM. Okay, for those of us not steeped in neurochemistry, what does that mean in plain English? How does it work differently?
Okay, think of it like this. Many old antipsychotics are kind of blunt tools. They might hit one main target, one neurotransmitter system hard, like forcing one specific key in a lock. Brilaroxazine is designed to be more nuanced, aims to sort of fine-tune multiple systems at the same time. It interacts with several different locks simultaneously. And the hope, the data suggests, maybe 2 main benefits from this. Potentially better efficacy, getting the job done better, and crucially, potentially better tolerability, fewer side effects.
And tolerability, that's a massive issue with existing psychiatric drugs, isn't it? What specific problems does brilaroxazine hope to avoid?
Oh, absolutely huge. Current meds often have side effects that are so bad people just stop taking them. Things like metabolic syndrome, serious weight gain, blood sugar issues, high blood pressure, major long-term health risks. And then there's EPS, extrapyramidal symptoms. That's stuff like uncontrollable muscle movements, tremors, feeling really restless and uncomfortable. It can be debilitating. Brilaroxazine's multi-target approach seems, at least in the data so far, to lessen these specific issues. That could be a game changer for quality of life, a real selling point if it holds up.
And the potential market isn't just one niche area either.
No, not at all. They're going broad. Unlike some biotechs that focus really narrowly, Reviva is exploring brilaroxazine for a whole range of multi-billion-dollar conditions. We're talking schizophrenia, bipolar disorder, major depression, ADHD, even potentially psychotic symptoms in dementia patients. And they recently put out some positive data from their phase 3 extension study, the Recover study, back in August 2025, showed, good long-term efficacy and safety in schizophrenia. So reinforcing that potential. But, and this is the big but, connecting that huge potential upside back to reality, you have to look at the fact that this is a pre-revenue clinical stage company. The risk is just as significant as the potential reward.
Right. So if the drug's success is basically a coin flip, maybe not 50-50, but still binary, then the financial runway, the cash they have to get to that outcome needs to be rock solid. What does the balance sheet actually look like?
Yeah, this needs serious scrutiny. They're pre-revenue, burning cash. The sources mention a net loss of about $27.11 million over the last 12 months. That works out to an EPS of minus $0.64. And the company's market cap is relatively small, around $56–57 million. So every dollar counts.
And didn't they just do a financing round? That usually signals cash is getting low.
Exactly. They did a public offering back in September 2025, managed to raise somewhere between $9 and $10 million, selling shares at 50 cents each. The stated goal is specifically to raise capital, which, of course, immediately brings up the risk of dilution for existing shareholders. More shares out there means each existing share owns a smaller piece of the pie.
Can we estimate how long that cash might last them based on their burn rate?
We can try a rough calculation, yeah.
Yeah.
Using that $27 million loss over 12 months, that suggests an average monthly cash burn of, let's say, around $2.25 million. Now, if you assume that $10 million they just raised goes straight onto the balance sheet, well, that gives you maybe 4, perhaps 5 months of cash runway. Just a rough estimate, of course.
4 to 5 months. Okay, that really highlights why the upcoming Q3 earnings report isn't just routine. It's potentially critical for understanding their immediate survival.
Absolutely critical. The sources really hammer this point home. You, the listener, must check the latest 10Q, the official quarterly report. You need to verify the actual cash balance and the current burn rate. Until that runway is crystal clear, the threat of needing more cash and therefore more dilution hangs over the stock. It puts a serious damper on the whole bullish story.
Okay, so given that cash pressure and the fact the stock is down, 70% from its peak, but we've also seen these recent spikes in trading volume, something's definitely brewing. What are the specific upcoming events, the catalysts, that can really move the needle here in the near term?
The next 3 to 6 months are absolutely packed. It's make or break time. The most immediate thing is that Q3 2025 earnings release, expected around November 7th, maybe November 13th, according to some sources. Obviously no revenue to report, but management's commentary will be key. Updates on the trials, the real cash runway, any hints about partnerships. That's what everyone will be listening for.
And for any biotech, it always comes back to the regulators, right? The FDA.
That's the big one looming early next year, 2026. They're expecting what's called a pre- and NDA meeting with the FDA, probably around January 20th. NDA is the new drug application. This meeting is where the company basically asks the FDA, okay, what exactly do you need from us to file for approval? Getting positive feedback there, that would be a huge de-risking event.
What about clinical data before then? Anything to watch for?
Yes, definitely. Keep an eye out for results from the Phase 23 schizophrenia trial and also Phase 2 data in bipolar disorder. Both are expected sometime between Q4 of this year, 2025, and Q1 of 2026. Positive results here are what could really validate the whole scientific premise. That's likely the trigger for the kind of big price jump the analysts are predicting. Oh, and one other thing, those institutional 13F filings due November 15th, that'll show if big money managers, hedge funds were buying shares during that recent volume surge. Could be telling.
So lots of potential catalysts, very high stakes. What's the single biggest risk tied to these upcoming events?
It's the clinical trial risk, full stop. Developing drugs for brain disorders, neuropsychiatry, it historically has one of the highest failure rates in the entire pharma industry. It's incredibly complex. If any of these upcoming data readouts are negative, if the drug doesn't work as hoped, or if new safety issues pop up, the sources are unanimous on this, the stock price would likely plummet, collapse, probably, potentially heading towards that 52-week low around 25 cents. This isn't a typical investment, it's much more like a scientific bet.
Okay, so binary indeed. Potential 2,400% gain versus near wipeout. Given that, what's the speculative buzz around this, and how should someone even think about structuring an investment here, given the volatility?
Well, the speculation is naturally running high because the potential market is so large. There's constant chatter you see, online forums, analyst notes about potential M&A, acquisition, or partnership deals. The big players in CNS, central nervous system drugs, think Johnson & Johnson, AbbVie, maybe Eli Lilly. They're always scouting for promising late-stage assets like this. If brilaroxazine keeps showing good data, especially after a positive FDA meeting, it becomes a very attractive target for a buyout. And there's also some debate, could they possibly get an accelerated filing based on the phase 3 data they already have? That's probably a longer shot. Depends heavily on the FDA seeing a really high unmet need.
All right, so pulling it all together, the massive potential reward, the huge financial and scientific risks. What's the final verdict from the source? Is it a buy now or not?
The sources lean heavily bullish, rating it quite high, maybe 7.5 out of 10 on a bullish scale. But with massive caveats, the core idea is this is highly speculative. It's all about that binary outcome. So they see it as highly attractive for short-term traders, people trying to play these upcoming catalysts in the next, say, 0 to 3 months, betting on positive news about cash or data. It's also seen as attractive, but only for very risk-tolerant long-term investors, the kind who truly believe in the underlying science, the potential of that SDAM mechanism, and are willing to wait.
And what about someone who's maybe a bit more cautious?
For conservative investors, the advice is pretty clear. Avoid. Stay away entirely until there's positive phase 3 data confirmed. That would take a lot of the scientific risk off the table and give a much clearer view of the path to approval. And even for aggressive investors who do decide to take the plunge, risk management is absolutely paramount. Think about a very small position size. The sources suggest maybe 2%, 3% of a portfolio maximum. Size it so you can genuinely afford to lose the entire amount. And then you have to actively monitor everything, the cash situation, every single clinical update. It's not a set it and forget it investment.
So the bottom line seems to be extraordinary potential upside, maybe 700%, maybe over 2,000%, but it all hinges entirely on hitting specific milestones in the next few months. It's a bet on the science of a unique drug.
Exactly. And, it raises an interesting final thought, especially with all the economic uncertainty floating around right now. The sources mention the stock has a negative beta, around NACA 0.09. Beta basically measures how much a stock moves with the overall market, like the S&P 500. A negative beta means Reviva's price movements are largely independent of what the broader market is doing. If the S&P drops 10%, theoretically, this stock moves based on its own news, the science, the FDA, the cash. So the question for you, the listener, is, in these uncertain times, does that potential insulation from market noise, that pure focus on scientific catalysts, actually make a high-risk play like this more appealing, maybe as a diversification tool within a portfolio? Something to think about.
Definitely something to chew on. Well, thank you for joining us for this look into Reviva Pharmaceuticals. We hope digging through these sources was useful for you. Let us know your thoughts in the comments. We'll see you next time on Investing Talk Podcast.